In October 1997, Victor Niederhofer, a guy who was ranked the #1 hedge fund manager in the world at the time, by the way, saw his entire $70 million fund as well as his personal savings get wiped out in a single day by market movements that he thought was statistically impossible. James Cordier, the founder of optionsellers.com, watched his $150 million fund vaporize in 2018, again due to losses that were far beyond what he assumed were possible. In fact, his clients got hit with margin calls as they now owed money to the broker. It's easy to think that the losses were solely caused by irresponsible decisions on their part, right? But what if there was something deeper going on? There was a massive hedge fund in the 90s called Long-Term Capital Management that was established alongside Robert Merton and Myron Scholes. These names seem familiar because they literally created the option pricing models that we use today. But somehow, even they fell prey to a similar fate, even though their computer models said it was theoretically impossible. Even the 2008 housing market crash was partly a result of banks assuming that there was a non-existent chance of widespread defaults on mortgages happening. So in order to see what really happened, we need to understand the assumptions that they and most traders likely make regarding how stock prices move. The intuitive way that people think of stock market returns is in a bell curve shape called a normal distribution. The reason people assume this is because most things in our daily life, like the height of people, sizes of fruits, exam scores, they all behave this way. The probability of outcomes are symmetrical and they're clustered around the middle, with the outcomes on either side being categorized by how many standard deviations they fall away from the middle. There's a 68% probability of outcomes falling within the first standard deviation, 95% of them within the second, and 99.7% within the third. So if you move further away from the middle, the probability that that particular outcome happens drops off exponentially and quite predictably. However, if we compare this idea to real market returns, it shows some stark differences. On the time series of S&P 500 returns here, we can see how the left end of the distribution is elevated compared to what we saw before, meaning the probability as well as the severity of large moves to the downside is much higher than what we previously expected. The whole curve in general is also just heavier towards the left, which means while the markets tend to drift upwards slowly and incrementally during the bull runs, the downward corrections would tend to happen much faster and with a lot of panic. The normal distribution also assumes that the time series itself is unchanging, that it's a static graph, which is another key difference with real-world returns. We might logically think that after a large down move that ranks as very low probability on this scale, it cannot possibly happen again the next day, right? But the fact is that real-world returns are highly correlated to their own recent history. That means one highly volatile day is likely to be followed by another highly volatile day. The time series itself waxes and wanes to reflect low and high volatility regimes. The fracture point for many traders and institutions in the past was their usage of a model called parametric value at risk for their estimations of their loss potential, which answers a pretty straightforward question of what is the worst case loss that I can expect to see within a specific time period and with a specific level of confidence. Which means, for example, if a portfolio has a 97% confidence, one-day value at risk of rupees 1 crore, it means that there is a 97% probability that the portfolio will not lose more than 1 crore tomorrow. The fatal flaw in this methodology that they used is of course the fact that it assumes that stock market returns are normally distributed. So it's obviously blind to both the severity of loss that can happen, say, beyond the 99th percentile mark, as well as the increased frequency of these events. A fund manager would probably feel comfortable using this methodology, thinking that he's not likely to lose more than 1 crore like we saw in the previous example. But the reality is, it's easy to see how his loss could even be 100 crores. It's also possible for the manager to just game the metric itself by selling, say, deep OTM options, which would have a high probability of profit, but the losses would exponentially shoot up in the 1% that is not covered by that parametric value at risk formula. This is in fact exactly what contributed to the wipeout of James Cordier. Because of the whole system-wide collapse that happened during the 2008 housing market crisis, some improvements were made in risk management followed by banks, where they took on this different formula called conditional value at risk. What this does is basically it calculates the average loss that can happen within that excluded window during some particular stress regime. So it gives a much more realistic estimate of what they stand to lose. Now, what would all of this mean for present-day traders? Let's say you're an options seller. The wise thing to do would be to buy the wings, right? It's a small price to pay to protect yourself from these catastrophic events that we now know are much more common than we thought. If you hold an equity portfolio, an idea would be to accumulate some deep OTM long puts during low volatility regimes when the option prices are low, so that in the event of one of these large down moves that are again much more common than we thought, our portfolio would be hedged and protected from ruin. If you want to be more experimental, another idea is Nassim Taleb's barbell strategy. According to this, we can benefit from chaotic market movements by keeping 80 to 90% of our funds in stable capital preservation sort of things, and the remaining 10 to 20% in highly speculative ideas to both the upside as well as the downside. If you want to analyze market volatility at a level deeper than commonly available platforms so that you can structure your trades better, you can check out my free project linked in the description below. If you liked my video, do click the like button below so that it gets recommended to more people. And I'll see you on the next one.